Well, good afternoon, everybody. Joe Lucey here, president of Secure Retirement Financial, and I want to welcome you to the August 31st, 2020 Market Minute with Joe Lucey. So, probably the number one question that I am hearing right now when I'm out and about. So, for example, I'm with a friend of mine. We're playing around the golf, and sure enough, by about the fourth hole, the conversation turns to, what about that stock market? When is it ever going to end? It shouldn't be where it is. What should I be doing now? There's a saying that I heard at one time, and it said basically that there are decades where nothing happens, and then there are weeks where decades happen. And certainly up until now, 2020 has definitely been one of those types of, let's call it weeks, maybe months. Keep in mind that last week, the S&P 500 was up every single day. So far in the month of August, we've actually only had 3 down days. Today looks like it may be the 4th. So 75% of the month, the S&P 500 has been going good. And so what today's market huddle is going to be about is I want to address some of the things around what's going on in the stock market. Keep in mind, a lot of what I am going to be talking about is somewhat of an opinion. I can't basically state everything as a fact. A lot of the past performance of the markets, I can't predict the future based on that. But anyways, we're going to kind of address those areas here in today's presentation. So let me do this. Let me get the presentation started, and then we will get up and running on this. And I'm going to go ahead and turn off the video. So again, this week's Market Huddle, how much more higher can the markets go? What's going on here? Here's that disclaimer. Again, some of the things that I might be talking about could be somewhat based on taxes. I'm not a CPA. I am a certified financial planner. We might be talking some legal things, but more important on this disclaimer this week is going to be about trying to predict the future. So keep in mind that a lot of what I'm talking about is based on what's going on today, August 31st, 2020. Things can change very rapidly. Again, decades can happen in weeks when we're talking about the market. So that's what we're going through. So there's really a couple different things I wanted to talk about, but keep in mind that when it comes to August specifically, corporate earnings have been far better than expected. We have the only downside, or the thing that seems to maybe be keeping the market a little bit in check, is that some of the stimulus expectations, additional stimulus checks and what have you, have kind of fallen apart a little bit. But I think that the market overall is feeling that a lot of this is going to be coming back. And the other thing that's really going on here is that the virus numbers seem to be kind of rolling over. They seem to be doing much better than they would. Now, there's really only 2 reasons why the stock market likes to go up. Number one is because earnings are increasing, and that really hasn't been happening this year. But the other reason is that the multiple of the earnings that investors are willing to pay, in other words, the expectations of future positive events, have gone up, and probably in a very historic way. Now, a lot of this has to do with Washington, the quantitative easing that they've put in, 0% tax rates, or 0% rates, not tax rates. Tax rates are still there, but 0% interest rates. That not only are we at a point where we're seeing very low rates, but they're actually promising us that they're going to continue to do that. Plus, we have a lot of families out there with stimulus checks and PPPs and even unemployment that where in past recessions or past pullbacks, maybe I go on unemployment, I'm going to be a little bit more cautious. But with the extra money that was been put into the checks, we haven't necessarily seen that. The other thing, and we're going to be talking more specifically about 4 or 5 different areas here, but if you think about it like this, we have low interest rates right now. We have a 10-year treasury that's paying a little bit better than 0.5%. Now, when I look at the S&P 500 and I look at the dividends that the S&P 500 is currently paying, it's about a 1.9, almost 2% rate yield on the S&P 500. In fact, if I go to corporate bonds and I look at a 30-day yield on corporate bonds, we're looking at a 1.9. So when I'm comparing the 10-year Treasury, which is obviously the safest place we can, backed by the federal government, only paying 0.5% or 0.6 something right now, versus the S&P 500 that's paying 2, even corporate bonds that are paying 1.9. Why wouldn't we want to put money into the stock market and potentially get a little bit better return? I think the number one question that families have as we talk about today is really, can this continue? And I think the short answer is, I think it can. So let's get into why I think so. So first of all, we have the stock market now looking at this pandemic, the COVID, as having a end date. Keep in mind that there's a lot of discussion out there about potential vaccinations. In fact, there's been some vaccinations that have been kind of put on a fast track here. There's some, in fact, I think that President Trump recently said that he expects to see a vaccination here before November. So that's definitely something going on here. It's also causes some potential risk when we start looking at things, because should all of a sudden the pandemic kind of come back in force here, and all of a sudden we end up with hospital ships and such getting sent off, another downturn, that could possibly be some risk. But I think that the markets are what I know the markets are basically anticipating that is probably not the case, and that whether it's AstraZeneca's new vaccine or another one, that's kind of around the corner. So as we get to more certainty around the coronavirus, that's probably going to continue to help drive the market. Now, again, the other thing and I just talked about this a few minutes ago, are the low interest rates. When we have a 10-year Treasury paying about 0.5%, and I can get almost 2% out of the S&P 500 in dividends, it starts to look much, much more attractive. The other part about this is that we've got interest rates right now that are being promised to maintain their low. In fact, the Fed has said that they believe that interest rates will stay at these levels through the end of 2021. Which really is kind of doing a lot to stimulate the economy. We have the stimulus, the quantitative easing. They talk in if you watch CNBC, they're going to be talking about M2 supply, the amount of money that's in the economy, and it's substantially higher than last year's levels. If I look at last year's levels, M2 is up about 25%. Now that is a really significant number. Historically, money supply and stock markets tend to work in conjunction with each other. As one goes up, the amount of money in the markets, the other one tends to go up as well. So we're seeing a whole lot of that. And part of the things to keep in mind here are that the S&P 500 is not necessarily the same as the gross domestic product. It's not the same as growth of our economy, where a lot of the S&P 500 is more manufacturing driven. GDP is more service driven. So services economies are hit harder during the lockdown. Think of the restaurants and what have you that were closed, but yet families or neighbors that were working in the manufacturing industry, a lot of them have continued, maybe not the same way they were, but they've continued to continue to pump out and do things. Plus, the capital investment has been skyrocketing. Amount of money going into improving efficiencies and what have you in manufacturing, things are going up. Plus, on top of that, just on top of one more thing, we have the S&P 500. Keep in mind, the S&P 500 is a very global indice in relation to the gross domestic product. Gross domestic product is how much is the U.S. growing, how much are we exporting, and things like that. 40% of the S&P sales are derived from international business, and that means that the U.S., while we are a net importer, and the S&P 500 itself is more of a net exporter. There is actually a lot more money going or goods and services being sent out, and on all of this has been helped with a little bit weaker dollar that the stimulus has generated. Finally, I think that we're starting to see more and more certainty around what you can expect out of the next election. I'm going to, without mentioning or getting into the politics of it, I think that the viewership of the RNC convention was much higher than the DNC. I think that overall, I think that there was a lot of momentum that's been generated after the RNC, and forget what Joe Lucey thinks. I'm telling you that the stock market is starting to feel like there's going to be more of what we've seen out of Donald Trump. You may or may not like that, but the markets themselves are starting to place their bet on where they think things are going. And the markets like certainty. They like to know what changes. So what are the risks around the presidential election? If you listen to us on Secure Retirement Radio, we talk about how this contentious election, what that's going to do to the actual markets. I believe that if you are pulling out of the stock market or trying to time the markets based on what you anticipate could happen around the election, I think that you might end up being on the right side, but for the wrong reasons. The things that are going to drive the stock market around the presidential election. So historically, once the actual election occurs, even look at 4 years ago, the markets rallied into the end of 2016. The market rallied more so because they had some certainty, they had some clarification on the direction of the economy. A lot of the things that we're seeing in the markets over the next few months, over the next 60 days or so as we get into the election, are going to really be driven around, they're going to be recognized by the market before the actual events occur. So if all of a sudden it looks like there's going to be more of a change towards one candidate or another, we'll start to see the markets already anticipate that. Does that mean we should get out of the market? Maybe. I'm going to talk about that here in the next two slides. So the next slide is keep in mind what Peter Lynch says. Peter Lynch ran the Magellan Fund for most of the 80s. He's well recognized as one of the best investment managers of all time. Peter Lynch says far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. So do I think that there's risk around additional coronavirus shutdown? Absolutely. But do I think that we should be pulling all of our money on the side and waiting for that to occur? I think that Peter Lynch may come out right on that. I think if we are long-term with our money that's in the markets, meaning that we are not in a position that we're going to have to withdraw money from the accounts over the next 12 months, certainly, but over the next 3 years, then I think that staying fully invested through this is probably a good idea. There's also, of course, risk around the political things. There's also some risk, I think less likely, though, around interest rates and what have you. I think that interest rates going up substantially fast right now is probably going to be controlled by some of the Fed and monetary policies around quantitative easing and such. So I think that that's far less likely than maybe a shutdown again through COVID or some surprises around the election. But with that said, for the most part, I think the markets tend to be forward-looking. They tend to be good predictors of the future, and I think that they're already kind of baking a lot of this in. So unless there's a substantial change in the direction, I don't know if that's very likely. So did I just say to make sure that you take every penny you have and put it in the market? Not really. I want to talk about this guy here on the screen. Now, I know that a lot of you think he looks like Shakespeare, and in my presentation, sometimes I'll ask somebody if they recognize him, and Shakespeare is the #1 answer we get, but his actual name is Oliver Cromwell. If you're not familiar with him, he was a English military political leader who served the title Lord Protector of the Commonwealth of England and Scotland and Ireland during the 1600s. Pretty big title, I guess. But what his real claim to fame is that as he was leading his troops across a river during one of the battles, and these were back in the days when there was muskets and powdered gunpowder, everything had to be manually loaded one at a time, 1600s. He said, we get to the other side of the river and you're not ready to take action, then the opportunity presents itself, then you're going to find yourselves dead. He says, make sure that you trust in God, but mind to keep your powder dry. Why do I bring this up? Because while I fully anticipate the markets are going to continue to probably do well, I think they're more likely to be up in a year than they are down, even with everything else going on. I think that there might be some opportunities here. If you're in a position as a retiree that you are going to be required to take money out of a market that just came down, whether artificially, like the 37%, or short term, like the 37% drop we saw in the spring, or maybe just due to something else, where I'm forced to take money out of the markets to maintain my obligations, we need to make sure that we follow the number one rule of income planning, and that's never have to rely on the stock market to make sure that I can pay my bills. If you have obligations, whether they're children going to school or grandchildren or taxes or a family vacation or whatever this is, make sure that that money is set aside. If it's important enough that you would not choose to forego that, make sure that the money is set aside, including up to 3 years or 5 in some cases of income. Keep in mind that when it comes to retirement planning, we a lot of times talk about mailbox income, money that hits the checkbook regardless of what's going on Wall Street. I want to make sure that I'm optimizing my sources of mailbox income like Social Security. I want to make sure that if I have a pension, I'm making smart and savvy decisions around Social Security and my pensions. And the higher that mailbox income, the less I'm going to be forced to take money out of a market. But if there is a gap there, let's make sure that we discuss different options on how to fill in those voids. If you're going to be forced to take money out of a market that just got beat up, you want to make sure that you are well protected. Quick recap here today. Why are the markets going up? Well, a lot of it I think is generated because of Washington and such, and some of it's because the stock market itself is a forward indicator. It starts to predict the future before the future ever occurs. So what are they predicting? Number one, we know that the pandemic, we don't know, but the market's telling us that the pandemic is probably starting to slow down. There's a very good chance that we are going to see additional cures or treatments and such, and maybe even vaccinations even before the end of this year. And the markets love that. They love the fact that the coronavirus, which slowed down the economy, could be near its end. And I believe that before the actual vaccination or whatever it is that's going to reduce the focus on the pandemic comes to an end, before that actual event, the markets are going to act positively to the positive news around the pandemic and potential cures or vaccinations to the coronavirus. So that's going to keep the markets going well. The interest rates, we have a 10-year treasury paying less than 0.65%. Historically, all-time lows. We've got the S&P 500 dividends that are closer to 2%. We got even corporate bonds that are paying about 1.9%. Why wouldn't smart money be putting money into the markets, getting a better rate of return off of dividends and interest than trying to just rely on the S&P or the 10-year treasury? So low interest rate environment is keeping the markets kind of revved up. And then we combine that with this substantially higher M2 money supply that's in due to the quantitative easing and what's going on. And then, of course, as we get to certainty around the election, I think all these things are going to keep the markets going up. So I'd follow Peter Lynch's advice. Let's make sure we keep the money working for us. That's long-term money, but also heed Oliver Cromwell's advice. Trust in God, keep the powder dry. If you've got money or obligations that you're going to be paying for the next anytime between the next week to 3 years, I encourage you to sit down with one of our team members. Let's look at some options for you on how we can make sure that we get a fair rate of return on that, but yet don't expose that to the market. One last point here. Because of Labor Day here next weekend, we will not have a market huddle. But keep in mind that everybody's going to get a copy of this. If you've got somebody that you'd like to forward this on to, feel free to do that. Right now, probably about 40% of our new clients that are working with us here at Secure Retirements are coming from clients just like you that are forwarding on these type of videos or forwarding on our name. So I encourage you, we really appreciate that when you do that. If you're not a client of ours and have anything you'd like to discuss, whether it's the ongoing market growth or maybe just how to create an income plan or doing some of the look forward tax planning we've talked a lot about on these market huddles, feel free to reach out to us. Here is the ability to schedule a review. Did I do that? No, I didn't. Here it is. So if you click on that, you'll automatically be added to one of our team members for a 15 to 30 minute phone call where we can just discuss whatever is the most important action step you should be taking right now when it comes to retirement planning. Use this as a resource. Don't feel like if you're already a client of us, we love talking to our clients, so feel free to reach out to us. And if you're not a client, what's 15 minutes going to hurt? Get a second opinion. See if there's something that we can add to your retirement planning that'll make a substantial difference in the direction it's going. And if you know anybody else that's concerned about the recent market activity, again, we were only down 4 days in the month of August. That's assuming that the markets dropped down today. That is historically not the way that the markets tend to go. I think we're in unprecedented times when it comes to that. I think the markets are going to continue to be unprecedented. And as we get through this, as we see positive information, whether it's regarding coronavirus or possibly political type things, I think, or even a passage of the stimulus that they're threatening to do, all of this is going to bode well for your investments that are in the stock market. With that said, here's how you can also reach out to us if the click isn't working or whatever. If you'd rather just find some time to reach out to us, feel free. Give us a call at 952-460-3260. With that said, I hope everybody has a great day and a great week. And tomorrow's September already. Where did the year go already? Anyways, have a great rest of your week.